All right, diving in, you guys sent over some seriously interesting stuff. Excerpts from Rich Dad, Poor Dad. This deep dive, we're going for the gold. Not just skimming the surface, but really extracting those core principles. Especially those contrasting viewpoints from Kiyosaki's, Rich Dad versus Poor Dad. So you walk away like genuinely equipped to make some moves.
Yeah, absolutely. It's like, think of it as a roadmap. Forget the basic summary. We want those light bulb moments. You finish this and you're like, wait, I never thought of it that way. A whole new perspective on personal finance, how to build real wealth, all that.
Exactly. And it all hinges on these two father figures, right? Both struggling financially at the start, but their whole outlook on money, worlds apart.
Totally. And that's where it gets fascinating. We're going to unpack how those contrasting figures, rich dad, poor dad, those different lenses, they're going to help us challenge your own assumptions about money, maybe even unlock some brand new approaches you've never considered.
Love it. So, right off the bat, Kiyosaki hits us with this stark difference in their core philosophies. Poor dad, super educated guy, believed the love of money is the root of all evil. But rich dad, the one who actually built serious wealth, he flips the script completely. The lack of money is the root of all evil. Mind blown. How did this fundamental clash play out in their daily lives?
It's like the DNA of their financial choices. See, that belief of the poor dad, it often led to playing it safe, prioritizing stability above all else.
Yeah.
Risk, no thanks. But the rich dad, he saw money differently, like a tool to be mastered. It pushed him to constantly seek knowledge, to hunt for opportunities. It wasn't about greed, not for him. It was about understanding that not having enough, that breeds anxiety. It limits your choices. So listener, right now, think about it. What are your core beliefs about money? Are they pushing you forward? Or are they holding you back, rooted in that fear of scarcity?
Deep stuff. And this difference in philosophy, it totally shaped their approach to education, right? Poor dad, classic route. Excel in school, land a good job, skills, skills, skills. But rich dad, he was all about something that often gets overlooked. Financial literacy. That street smarts about money often learned at home, but so many families don't even talk about it.
You nailed it. And Kiyosaki makes this point. It's like a wake-up call. You can be brilliant, top of your class, but still struggle financially if you don't have those financial fundamentals. Look, we're not saying ditch your degrees. It's about acknowledging that school prepares you for a profession, but not necessarily to master money itself.
Right. It's the difference between being great at your job and actually being financially free. And that ties into their contrasting ideas about self-reliance versus entitlement, right? Rich dad was all about taking charge of your financial destiny, owning it. Poor dad leaned more on job security, those benefits from an employer.
Two paths, two totally different mindsets. One's about actively shaping your future. The other is about relying on these external structures, hoping they hold up. And you see this even more in how they tackled money problems. Poor dad. Instinct was to save. A safety net, sure, but maybe not enough to actually grow. Rich dad. He was about making investments, putting that money to work.
Totally. And this wasn't just some theory they debated. It led to super practical advice. Poor dad. Polish that resume, get the best job possible. Rich dad. Write a business plan, learn financial projections. Totally different skill sets. One's about finding a secure position. The other's about creating something that generates wealth.
And under all this, Kiyosaki's big observation, our thoughts shape our reality.
Yeah.
Especially when it comes to money. The two dads, they're like living proof. How you think about money can literally determine your financial future.
And the book brings this to life with those early entrepreneurial stories from your childhood. Like the toothpaste tube business. How did that even come about?
It's pure kid ingenuity.
Yeah.
I mean, we were inspired by a science book and thought, hey, let's melt these down, resell the metal. We even had this little production line, milk cartons, a hibachi grill. It was wild. And the whole neighborhood got involved, even asking us to use up their tubes.
But there was that slight roadblock, wasn't there? Poor dad stepped in. Important lesson, but kind of a bummer about counterfeiting, right?
Oh, yeah. Reality check. Our operation got shut down pretty quick. But here's the thing. Poor dad's reaction. He could have just focused on the legal side. But instead, super encouraging words. He told me, you're only poor if you give up. The most important thing is that you did something. It's a powerful lesson, even back then. Resilience, taking action. Listener, think about that. Even a so-called failure, it's a stepping stone.
Totally. Action over just dreaming. And then there was that memorable experience working for Mike's dad. 10 cents an hour. Must have been a bit demoralizing.
Oh, yeah. Well, it's 30 cents for 3 hours on a Saturday. Rough.
Yeah.
You wanted to quit. Totally understandable. It's that classic trap. Trading time for pennies.
But this was all part of Rich Dad's plan, right? Not just some random low-paying gig. a real-life lesson in finance. Your poor dad was worried, of course, even suggesting it might be illegal, telling you to demand more or walk.
And that's the beauty of it. Two different worlds colliding. Poor dad's coming from that classic employee mindset. Your time is valuable, get paid what you're worth. But rich dad, he was going deeper. Those 10 cents weren't about exploitation. He wanted me to question the whole idea of working just for money.
And that's where we get to this core distinction, right? Working for money, driven by fear, versus having money work for you. Rich Dad said that fear of not having enough, the bills, the job security, it keeps most people on this treadmill. Slaves to money, he called it. And it's so true how our emotions can hijack our financial thinking.
Big time. Fear takes over. Instead of a clear plan, it's just reacting, hoping more money will solve everything. But often it doesn't. You work, you earn, but that anxiety, it's still there. Rich Dad wanted us to break free from that, to build assets, create a system where money flows in, regardless of whether we're clocking in.
And just when you think you have some money to flow in, there's taxes. Rich Dad was big on explaining how they're everywhere. Earning, spending, saving, even passing it on.
The big takeaway. The government often gets its cut first, before you even see your full paycheck. It means just making more money isn't the answer if you don't understand how taxes work, how they impact your overall financial picture.
It's all connected, isn't it? Now, let's talk about escaping the rat race. That picnic table conversation with Rich Dad, he lays it out, no sugarcoating. He talks about people like Mrs. Martin, the softball players, working hard but for limited rewards. They're clinging to that job security, looking forward to, a couple weeks vacation, a decent pension someday. What was your big takeaway from that?
It was about recognizing this trap, the illusion of security in a traditional job. Those folks, super hard workers, but they're trading their time for a limited income, with very little control over their financial future. It wasn't about dissing their work ethic. It was about seeing that limited perspective, the lack of real ownership over their financial destiny.
And we're back to emotions driving our financial decisions, right? Fear and desire. He argues that instead of confronting those feelings head-on, thinking logically, we react emotionally. Fear of not having enough, desire for that instant gratification.
It's like this feedback loop. Fear pushes you to get that job, that paycheck. But for many, it's not enough. And so you keep working, earning, but that anxiety, it sticks around. It's about recognizing those moments, when your emotions are in the driver's seat, not a well-thought-out plan.
That's where the briar patch comes in, like in the Brer Rabbit story. Fear and greed, those are the obstacles. And the way through. Choosing your thoughts, your actions, instead of just reacting, not getting stuck to that tar baby because you let your emotions lead.
You got it. It's about pausing, analyzing things rationally, not just jumping at every shiny thing or cowering when things get tough. You're in control of your response.
And that leads to this, kind of radical idea. The value of working for free. At least in the beginning.
Yeah.
Seems counterintuitive, right? What was the logic there?
It's about shifting your focus. Take away that immediate need for a paycheck, and your mind opens up. You start seeing opportunities that others miss because they're so fixated on that next dollar. It's an investment in your long-term financial intelligence.
And that's how the comic book library was born, right? No pay, but a whole lot of learning. How did that opportunity come up?
It's funny how things work out. We found this distributor discarding comic books. Couldn't resell them, but we could have them. So we got creative. Lending library in Mike's basement, his little sister as the librarian for a small fee, of course, tapped into a real demand in the neighborhood.
Genius. And surprisingly successful, right? Bringing in a decent chunk of change each week. But beyond the money, what was the biggest lesson?
It was proof. We were making money without directly trading our time for it. That library kept generating income even when we weren't there. It was Rich Dad's principle in action. Shifting from working for money to owning something that generates income, even passively.
And that takes us to a core concept in the book, assets versus liabilities. But before even defining them, Kiyosaki throws in this sobering story. The wealthiest people in 1923, their fortunes basically vanished within decades. What's the point of starting with such a stark reminder?
It's like a slap in the face.
Yeah.
These were the financial giants, right? On top of the world. And yet, many ended up broke. It shows that just having money, without understanding it, without a solid foundation, it's a house of cards.
A stark reminder that wealth without knowledge is fleeting. And speaking of foundations, he critiques what we're supposedly taught by schools, their financial foundation. He compares it to houses built on shaky ground. What's the deeper meaning there?
He's saying traditional education misses a crucial piece. Financial literacy. Most people graduate unprepared for the real world of managing money, building wealth. They might build a good life, a career, but without that solid financial base. One economic earthquake, and it all crumbles.
And that brings us to rule number 1. The foundation of wealth building, according to Rich Dad. Rich people acquire assets. The poor and middle class acquire liabilities that they think are assets. It's deceptively simple, but its implications are huge.
It's the heart of the matter, and so many people get this wrong. Kiyosaki argues that most financial struggles stem from this. Not knowing the difference between what puts money in your pocket and what takes it out.
So let's break it down. Simple terms. What's an asset, according to Rich Dad?
Something that consistently puts money in your pocket. Think rental income, stock dividends, interest on bonds, royalties from creative work. A successful business that runs without you constantly there, they all generate positive cash flow. Over time, they add more to your income side.
And the flip side, liabilities.
Anything that consistently takes money out. Your mortgage, car loans, credit card debt, even that fancy gadget that depreciates the moment you buy it, they're obligations, sucking money out of your pocket. They add to your expenses, dragging you down.
And he uses these simple definitions, plus this cash flow diagrams, to show how money moves differently for different groups. Even though they're simplified, what's the core message?
They show where the focus lies.
Mm-hmm.
Poor. Barely any assets. Income goes to immediate expenses. Middle class. Often trapped by liabilities, that big mortgage they think is an asset. Wealthy. They keep building that asset column, creating income that eventually outpaces their expenses. It's the direction of the flow that's the real story.
And that's why simply making more money isn't the magic solution. It's so tempting to think, I just need a bigger paycheck. But why doesn't that always work?
Because without financial literacy, more money often means more liabilities. Bigger house, fancier cars, you know the drill. You're still in that rat race, just on a faster track. It's financial aptitude that's missing. Knowing how to manage money, how to acquire assets that actually work for you.
So financial aptitude, not just about how much you make, but what you do with it. What are the key ingredients for building that?
It's a skill set. Managing your money well, protecting it from losses, holding on to it instead of blowing it all, and then making it work for you. It's about being smart with your finances, not just good at earning.
And he keeps pointing out this pattern. Income goes up, expenses follow right behind. Why is it so easy to fall into that trap?
Partly psychology, partly the system itself. More money. You want a better lifestyle? It's natural. Bigger house, nicer car, the upgrades start piling up. Plus, taxes often take a bigger bite out of higher incomes. And credit's so easy to get. It encourages more liabilities. You're running faster, but staying in the same place.
And this is where he challenges the whole, your home is your biggest asset idea, especially for the middle class. Can you unpack that?
Yeah, sure. A home can gain value, but it's primarily a liability. Especially with a mortgage.
Yeah.
It's constantly costing you. Mortgage payments, taxes, insurance, upkeep. If you're only focused on paying that down, you're missing out on building real assets, the kind that generate income and give you real financial security.
It makes sense, but it's a big shift in thinking for a lot of people. And this reliance on salary, on those liabilities, it leaves the middle class vulnerable, right? Especially with pensions disappearing and Social Security.
Well, who knows? Absolutely. They're dependent on that job, on systems they can't control. Job loss, recession, anything can happen. And those liabilities, they prevent you from jumping on opportunities. Your money's tied up.
So Rich Dad's solution, mind your own business. Not about quitting your job, but about focusing your energy elsewhere. What does that actually mean?
It means building your asset column. Consciously, consistently. Don't just focus on your income, your job. Acquire things that generate income. Not liabilities, not depreciating stuff. A new car loses value the second you drive it off the lot. Rental property. That can generate income for years.
And he gives specific examples of those real assets to prioritize. What are some of the big ones?
Businesses that run without you. Investments like stocks, bonds, mutual funds, real estate that brings in rent, royalties from creative work, anything that puts money in your pocket or goes up in value over time.
And then there's luxuries, those nice-to-haves. Rich people have a different approach, right? Compared to how many in the poor and middle class handle them.
Huge difference. The wealthy, they buy luxuries last, using income from their assets.
Yeah.
The poor and middle class, often it's the other way around. Buy the fancy car first, go into debt to do it. It looks like wealth, but it's a trap. Real wealth, it's built on assets, not appearances.
Now, we've got to talk about this. It's a bit controversial, but central to Rich Dad's teachings. The rich play by different rules, especially with taxes, corporations, all that. He talks about the Robin Hood fantasy taxing the rich heavily. What does he say about the unintended consequences of that?
He's not saying taxing the rich is inherently bad, but the reality is, people with real wealth, they often have the knowledge and resources to navigate this system, legally minimize their taxes in ways most people can't. It can end up hitting the middle class harder.
And he brings in history here, right? Taxes, how corporations evolved. How did those things create this financial gap?
Income taxes were originally aimed at the wealthy, but government spending grew and the net widened to include everyone. At the same time, the wealthy started using corporations more strategically. Originally meant for things like overseas trade, they became this powerful tool for lowering taxes, deducting business expenses before taxes hit.
So when he talks about corporations, he's not talking about these giant mega companies.
It's important to understand that a corporation, for these purposes, can be pretty simple. Just a legal structure, that file folder he talks about. It separates your personal finances from your business activities, and it comes with big tax advantages that employees don't get.
And this knowledge, how the game is played at that higher level, it creates a huge divide, what he calls the war between the haves and have-nots, especially when it comes to laws, financial regulations, all that.
Totally. The financially savvy, they often influence those laws, benefit from them. The average person focused on their job, paying their taxes, they can get left behind. It's why financial literacy is so crucial for everyone, not just the wealthy.
And it all comes back to that core idea, working for money versus having money work for you.
It's about control. Working for someone else, they hold the power. Building assets, creating income streams. That gives you options, flexibility, independence.
All right, let's shift gears. Financial IQ. It's not just about knowing basic financial terms. What does it really mean to have a high financial IQ?
It's like a symphony. Accounting, investing, understanding how markets work, and the law, it all comes together. It's having all those tools so you can make smart, informed financial decisions.
And he contrasts how money flows for business owners and corporations versus employees. What's the fundamental difference there?
Most people earn, get taxed, then spend what's left. Business owners, corporations, they earn, then spend as much as legally possible on business expenses before taxes, then pay taxes on what's left. It's a huge advantage.
And he defines wealth specifically. It's not just about your net worth. It's how long you could survive without working based on the cash flow from your assets. Why is that a more insightful definition?
Net worth can be misleading. Some assets are hard to turn into cash, that survivability definition. It's about the income your assets generate compared to your expenses. It paints a clearer picture of your financial freedom.
And then there's the difference between your profession and your business. Can you clarify that?
Your profession is what you do for money, your job. Your business, in this context, is your asset column, those income-generating assets you build. A lot of people spend their lives working for someone else's business instead of building their own.
He has that great example of inventing money through real estate. How does that even work?
Let's say you structure a real estate deal. Create a $40,000 note that pays 10% interest. That's $4,000 a year in passive income, potentially with tax advantages. Now try saving $40,000 through a job. It takes forever, gets taxed along the way, and the interest you earn is taxed too. It's about making money work smart, not just hard.
So ROI is key. What's the big takeaway about that?
It's not just the interest rate or how much something might appreciate. It's about how efficiently your money is working for you. Maximizing returns, finding opportunities where your capital works the hardest.
And that ties into developing financial intelligence, being on the lookout for opportunities that others miss.
Absolutely. Financial intelligence isn't static, it's a journey. The more you learn, the better you get at spotting those hidden gems.
And he talks about two types of investors. What are they?
The majority. They stick to package investments, mutual funds, things like that, relying on financial advisors. The second type, they create opportunities. They raise capital themselves.
And for those wanting to be that second type, the creators, what skills do they need?
3 things. 1, seeing what others miss, finding potential where others just see problems. 2, raising money, not just going to the bank, being creative. 3, managing people, partners, investors, advisors.
And he's clear that not having a ton of your own money shouldn't stop you from making deals.
Right, people miss out because they think, I don't have enough. But learning creative financing, structuring deals to bring in outside money, that's a key skill.
And then there's this, sales and marketing. Why are those so important in the finance world?
Because even with the best investment, the greatest business idea, you have to sell it. Communicate that value, whether it's customers, investors, partners. Being able to persuade, to market your vision effectively, that's crucial. It's like the difference between writing a great book and actually selling it.
Now let's tackle those obstacles, the things that hold people back from financial freedom. First one, the fear of losing money. How does Rich Dad address that?
It's about understanding that fear is normal. Everyone feels it. But how you manage it, that's the difference. Rich Dad sees failure as part of the process. If you're too scared to fail, you'll miss out on the opportunities that lead to growth.
And then there's cynicism, that inner voice that shoots everything down. How does that sabotage us financially?
It closes your mind. Instead of analyzing, you just find reasons why something won't work. Often out of fear or lack of understanding. Sometimes what we instantly reject, that I don't want to attitude, that's where the opportunity lies.
He even mentions laziness. But sometimes being busy can be a form of laziness, right? Avoiding the real work. Financial planning, relationships.
It's about prioritizing. Are you actually productive or just busy? Are you putting off the things that truly matter for your financial future, for your well-being?
And bad habits, the big one. Not paying yourself first. Why is that principle so crucial?
Paying yourself first means allocating money to your asset column before anything else. Investments, savings, even when money's tight, prioritizing this forces you to get creative, to find more income to cover the rest. You're putting your future self first.
And finally, arrogance. Thinking you know it all.
That's the death of learning. Finance is always changing. Staying humble, being open to learning from others, admitting what you don't know, that's how you stay ahead.
Now, let's get practical. He gives Tara steps to awaken your financial genius. The very first one, find a reason bigger than reality. A spiritual want, he calls it. Why is this inner motivation so important?
It's your fuel. Building wealth, it's not always easy. There will be setbacks, sacrifices. That deeper why, that's what keeps you going when things get tough.
Second step, daily educational choices. Make time to learn about finance. He has that great example of that real estate seminar.
Yeah, $385 for the seminar. Ended up making millions from what he learned there. It shows you investing in your financial education. Often that's the best return you can get.
Number 3, choose your friends wisely. He talks about the B&I quadrants, business owners and investors. Environment matters, right?
It's huge. Who you surround yourself with. It shapes your mindset, your beliefs, your actions. Hanging out with financially successful people, that's contagious. You start thinking differently, seeing new possibilities.
Step 4, master one formula for making money, then learn a new one. He talks about the foreclosure process. Why this step-by-step approach?
It builds confidence. You get good at one thing, really understand it, then you expand. It's like building a solid base before adding more floors.
5, pay yourself first. We've already covered that. And the cash flow diagram makes it so clear.
Yeah, visually seeing it, putting that asset column first, it reinforces the whole wealth building mindset.
6, pay your brokers well for good advice. Their expertise should be making you money.
Good advisors, worth their weight in gold. Real estate agents, brokers, accountants, they have knowledge, connections you don't. Paying them fairly, it motivates them to work for you, help you succeed.
7, be an Indian giver. Get your initial investment back quickly, then essentially own the asset for free. How does that work?
It's about structuring your investments to recoup your initial capital fast, minimizes risk, and then that asset is all yours, generating income without your initial money still tied up in it.
8, use assets to buy luxuries, not liabilities.
That's about sustainability. Enjoy those nice things, but fund them with income from your assets, not debt. That's how the wealthy do it.
9, choose your heroes. Emulate successful people.
It's about learning from the best. Study their strategies, their mindset, even their mistakes. It's like having a personal blueprint for success.
And finally, 10, teach and you shall receive. Be generous with your knowledge.
Giving back, teaching others, it deepens your own understanding, opens up opportunities. You never know what connections, what collaborations might come from it.
He also gives all these practical tips beyond the 10 steps, right? Finding mentors, taking classes, making offers, looking for bargains, thinking big. And he brings in history a lot.
He's a big believer in learning from history and from people who've already done it. Find mentors who've walked the path you want to take. Take classes to sharpen your skills. Don't be afraid to make offers, even if they seem low. And always be looking for those hidden gems, those deals no one else sees. It's about training your mind to spot opportunities.
And he emphasizes over and over the power of ideas.
Money is just an idea. If you change your thinking, you can change your financial reality. It starts with a shift in perspective, then taking action, even if it's small.
He also introduces this concept, the cash flow quadrant. Briefly, what's that about?
It's a framework for understanding where your money comes from. Employee, self-employed, business owner, investor. The book dives deep into that, but the big takeaway, finding your path, your purpose, that's the real goal, not just a job title or a paycheck.
And he talks about his own journey, exploring different careers before landing in entrepreneur, teacher quadrant.
He's saying that finding your path isn't always a straight line. It's about exploring, learning, and realizing that true fulfillment often comes from more than just a job. It's about developing yourself mentally, physically, emotionally, spiritually, not just the mental side that traditional education focuses on.
Makes you think, are you on the right path? Are you
Mhm.
in the right quadrant? Now you've got to tell the pipeline story.
Ed and Bill. Ed, he carried buckets of water. Hard work, but limited reward. Bill, he built a pipeline. It took time, effort, but eventually water flowed effortlessly. It's about working smart, not just hard. Building systems that generate income, even when you're not actively working.
Powerful analogy. So, stepping back, what's the core message here from all this rich dad wisdom?
It's a mindset shift.
Mm-hmm.
Financial intelligence, understanding the real rules of the game, that's how you build wealth. It's about being proactive, taking control, building that asset column, not just working for money, but having money work for you.
And he encourages everyone to read the book, to really dig into these concepts. So, listener, what are you taking away from this? What resonated with you?
What pipelines can you start building in your life? What actions can you take today to move towards financial freedom? It's not about getting rich quick. It's about building a solid foundation, step by step.
So much to think about. Thanks for joining us on this deep dive. We've barely scratched the surface, but hopefully this gives you some solid takeaways. Keep those questions coming, and we'll be back with another deep dive soon. Who knows what we'll uncover next?